Good morning, everyone, or good evening for those that are in Australia, and thank you for joining us for our presentation, UK Inheritance Tax for Aussies. Just a couple of T's and C's. So this presentation is for information only, so please don't take this as advice, and hopefully you kind of enjoyed just kind of the presentation, take a few pieces of information out of this. So today's agenda, just to make sure you guys are in the right meeting, it's the basics of inheritance tax, domicile, and at the end we will have a question and answer session. Today's presenters, myself, Paul Davis, I'm a financial planning manager here in the UK, and joining me today for this presentation is my colleague, Kevin Tutt.
Morning or evening.
So I'm going to hand you over to Kevin.
Thank you, Paul. As I said earlier, good morning and good evening to everyone. If we can just start with the basics of inheritance tax in the UK. Inheritance tax is payable over above a certain limit. The certain limit is called a nil rate band, which is currently £325,000 per individual. In addition, if you own your own property, there is a residence nil rate band of £175,000. So collectively per person, that's £500,000 allowance for inheritance tax, and your spouse or your partner, each of those bands can pass to each other on first death. Thanks, Paul. If you can just move the slide. Thank you. So if we look at the taxes that come with inheritance tax, standard inheritance tax rate is 40% of anything in your estate over the threshold. So for example, a nice quick easy calculation, the estate's worth 500,000. The tax on that would be 70,000, which is 40% on 175,000, which is the difference between the nil rate band of 325 and the value of the estate at 500. As I said, in addition, the resident nil rate band, you can pass, this is relevant to you if you pass your property to a family member, and for the tax year, this current tax year, 22-23, that allowance per person is 175,000. So married couples and civil partners, they can pass their possessions and assets to each other, in most cases, free of income, free of inheritance tax. In addition, the surviving partner can use both the allowances on second death. What I mean by that is that if you've got 325,000 in your as your nil rate band and 175,000 as your residence nil rate band, if you own a property, collectively a married couple or a civil partner will then have 500,000 each, so they can afford to pass on £1 million via their estate without the need for specialist tax planning. If the first partner or married couple unfortunately meets their untimely death, then they can pass their £500,000 onto their surviving spouse. So on second death, that person will have the full £1 million to pass on via their estate. Other exemptions that can be used, there's something called potentially exempt transfers or PETs. What that consists of is an individual making unlimited gift of any value over and above the 325,000, and if he survives 7 years, then that potentially exempt transfer falls outside the estate and it just becomes simply an exempt transfer. If the survivor lives for 3 years, there is tapering relief from 3 to 7. However, if they survive the full 7, whatever gift they made falls outside the estate for inheritance tax purposes. If we look at some of the other exemptions, which you may or may not be aware of, an individual can give £3,000 each tax year without being added to the estate, and that is known, that 3,000 is known as your annual exemption. You can give that to one person, or you can split it to how many people you like. You can carry forward 1 year only. So the first year you can make your annual exemption is 6,000. There also is a small gift allowance, which allows you to make gifts of up to £250 per person each tax year. And in addition to that, birthday or Christmas gifts you can give from regular income, which are also exempt from inheritance tax. Gifts out of income. Normal expenditure out of income, you can make additional gifts which fall outside of your estate. What that means is that you can make payments outside of your usual living costs, out of regular income, to any individual, family member, and those payments fall outside your estate. They have to come from normal expenditure, and they can't leave you in a detrimental position financially after you've made the gift. Typical examples are paying rent for a child, paying into a savings account for your children, giving financial support for elderly relatives, or alternatively, grandparents can use it to help fund their grandchild's university fees. So a lot of people do take advantage of the normal expenditure out of income IHT exemption. Okay, well, I've just covered off the basics of inheritance tax in the UK. For any Australians, they obviously appreciate that inheritance tax, well, there isn't any at all. And one of the questions we do get asked when we give financial planning is the difference in taxes between living in Australia and living in the UK. And inheritance tax is a big tax which the Australians don't have in their homeland, so to speak, but it is an additional tax they will have if they emigrate to the UK and stay here permanently. I'll now pass you over to Paul to talk about domicile. Thank you.
Okay, thank you very much, Kevin. So Kevin kind of touched on a point there at the very end when he's talking about IHT in Australia. Yes, there isn't any IHT in Australia, and the reality is, many of you people who are attending this webinar today who are Australian, UK IHT may never impact on you either. But there might be some circumstances where it does. And just going back to basics, we're going to start looking at the concept of domicile and seeing where that might come in for some of you. But first of all, I'm just going to talk to you about what domicile is, and then that will tie in with where this will kind of fit in with potential IHT consequences for those Australians listening on this presentation today. So first of all, there's two key concepts. We've got residency and we've got domicile. So domicile is a legal term which is different to residency or nationality. It's much more permanent. So most people, when we have a look at their situation, we look at their domicile of origin, and that's something that you would acquire at birth. It's kind of, it's where your father is from, where you were born at the time. But it can get complicated when we look at people who then move to the UK and stay here for a certain length of time. So why is domicile important for IHT? Well, if you remain or if you become UK domiciled, your estate would fall into the UK IHT rules upon your death. And this is quite a crucial point, this would include your worldwide assets, not just those that you'd have held or acquired within the UK. So the question is, can someone change their domicile, or will their domicile be changed? So yes, it is possible to have a domicile of choice. To gain a domicile of choice, you must have settled permanently in the country you now consider yourself domiciled. You must intend to stay there for the rest of your life. And generally, you must break ties with your domicile of origin. So probably more pertinent to those of a UK background rather than Australian background, one step towards a new domicile of choice is that if you leave the UK, there must be at least 6 tax years as a non-UK resident in the 20 tax years before the relevant year. And then that's one big step before or towards breaking your UK domicile. However, this in isolation will not mean you will break your domicile of origin. So let's just run through an example. So take the actor here, Richard Burton. As some of you might be familiar, he was very famous actor throughout the 60s and 70s. He was born in Wales, very proud Welshman, but because of the huge amount of taxes that he was paying from an income tax perspective from many movie projects he was involved in, he moved to Switzerland in 1957. He spent the remaining 27 years of his life resident there, and therefore he wanted his domicile of choice to be Switzerland. And in the end, he was actually buried when he passed away in Switzerland. However, he had actually bought some burial plots in Wales for himself and his then wife at the time, on and off, Liz Taylor, and therefore HMRC considered the UK as his true home, even though he hadn't lived there. I think died in the mid-80s, but he'd lived in Switzerland since 1957. But because HMRC considered the UK his true home, his worldwide estate was subject to UK inheritance tax when he passed away. So remember, your domicile is where HMRC here in the UK consider where you actually belong. And one of the key things, and again, this might be at this point pertinent to those with a UK background, make sure that this is reflected in your will, particularly if you finally at the end of your career end up retiring in Australia. So if you're a resident in the UK, non-UK domiciled status carries with it the benefit of being subject to IHT only in respect of UK assets. So for those Australians that are coming over and coming to live here in the UK, anything you build up in the UK, or maybe you retain in the UK, would be considered for UK IHT purposes. But everything else worldwide, everything you retain in Australia, certainly to start off with, wouldn't be considered. So the idea would be that you'd be considered domiciled in Australia. You might be tax resident here in the UK, but still considered domiciled in Australia. However, and this is the crucial point now, after a long period of UK residence, the IHT position may be affected by the acquisition of deemed domiciled status. So this typically occurs at the beginning of your 16th tax year of residence here in the UK. So I don't know how many people listening on this webinar are on the precipice of spending that much time here in the UK, or those who are considering spending 16 years or more in the UK. But here's kind of a test, if you like, to consider whether you are considered a UK domicile or not. Now, look, we're going to provide these slides to you afterwards, so you don't need to kind of write this down or memorize this slide. But it's important to understand that there are various steps and various little tests that you need to understand in order for you to establish where you're domiciled. As I said, and the key thing about domicile is your exposure or your estate's exposure to UK inheritance tax on your death. So are there any things else to look at, or any kind of remedies to this solution, particularly for those who are considering moving from Australia to the UK, or in the UK already from Australia, and staying in the UK for the long term? So the tax impact of being deemed domicile can be reduced greatly by giving non-UK assets to a suitable trust, which I'm going to cover in a second. Such a trust can function as a long-term IHT shelter. There's obviously another complexity as well, because Aussies tend to marry POMs and POMs tend to marry Aussies. So there can be some domicile mismatches, if you like, when you've got one partner who's domiciled in the UK and one from Australia. So moving on to the trust that I was talking about earlier, as I said, if an Australian becomes deemed domicile in the UK, then the favoured IHT status, which Kevin touched on before, no IHT in Australia, can be lost if you're considered a UK domicile, which means all assets worldwide could fall into the state for UK IHT purposes upon your death. And again, that would include any assets that you accrued in Australia or any other part of the world for that matter. But it is possible that you can place non-UK assets in what's known as an excluded property trust just prior to becoming UK domiciled. So if you're approaching that 16-year mark I spoke about earlier, and that could save a potential 40% tax, UK inheritance tax, on these assets. I'm now going to hand you back over to Kevin to say we've touched kind of on IHT, and we've touched on the fact that Australians, unless they become UK domiciled, won't be subject to UK IHT, but there are one or two other points to consider.
Thanks, Paul. No IHT in Australia, but for Australian domiciles or people beneficiary of an Australian domicile estate, there is potential capital gains tax that will affect the estate. Australian resident beneficiary will not pay any capital gains tax on the asset they're left immediately, but when they dispose of it. And the acquisition value is the date of death, and the sale value is obviously the price that you receive for it. With property, that can be sold within a 2-year period after death without suffering any CGT, as long as the property was the deceased's main residence. This is where the rules slightly change. If the beneficiary of the estate is non-Australian resident, so i.e. living in the UK, all assets that are not taxable Australian property passed to a foreign resident through an Australian estate will be subject to CGT at the time that's paid. So what that means is the value of the asset, they will calculate the CGT at the market value at the date of death, and the CGT, the capital gains tax, must be recorded in the deceased tax returns and paid by the estate straight away. Now, the implications of that is that all beneficiaries within the estate will bear the cost, because it's quite simply the estate will pay this capital gains before the rest of the estate is divided out to the beneficiaries. That's quite a key point. That's quite a key difference for Australians living in Australia and receiving an inheritance, and Australians who are living in the UK and receive an inheritance. Thanks, Paul. So we touched on Australian taxable property and what it is, and if it's not what the capital gains tax position is likely to be. If we looked at, well, what actually does taxable Australian property include? And as the name suggests, I won't go through those points individually, but as you can see, it's all Australian real property, indirect interest, CGT, asset you've carried on your business through permanent establishment in Australia, and an option to purchase a property off plan, i.e. you've signed a contract. So if the property or the asset that you receive is included in one of those, then you don't pay the CGT straight away. If it's an asset such as a share portfolio, then there's different rules and the CGT liability is expected to be met straight away. Thank you, Paul. Okay, just to summarise,
yeah. So just by way of summary, I mean, some of the key points to take from this, I think would be, first of all, just think about the UK IHT and the nil rate bands. Some ways of maybe reducing kind of your estate that would be exposed to the UK IHT by possibly gifting. And I think one of the important things is the relationship between UK IHT and your domicile status. So I expect most of the people who are on this webinar today are non-domicile. And at the moment, and for a few years to come, their estate won't fall into the UK IHT net. However, that's not to say it's possible that it could happen in the future. And as I said, there are steps to maybe sort of reduce this, mitigate this, but it's something really to think about. Now, you know, in yourselves personally, you'll know how long you're going to spend in the UK or how long you've already spent in the UK. You may have a spouse or a partner, or there might be people here that originate from the UK and may be like unaware that their domicile could still be in the UK. So it's very important that you do consider that, because it does have an impact on your estate. So why bdhSterling? Well, we're dual licensed advisors. We define benefit pension scheme specialists, and we can provide advice under one roof for people in the UK with Australian assets, people in Australia with UK assets. We have the expertise throughout our offices. And it's important to note that we are able to provide other financial services such as Australian super and retirement planning. But one of the key things is we have a sister arm to our business, BDH Tax, and they can provide very specific tax advice, maybe around domicile if you're unsure, maybe around whether it's best to hold assets in one jurisdiction or another, you know, impact of split tax years, residency, and they can just help you with basic things like tax returns if you've got assets or income coming from emanating from one jurisdiction but you're resident in another. between the UK and Australia, they can complete tax returns for you in both countries and make sure that that all lines up for you. And finally, well, the value of advice. So we can provide professional advice, helping you to define your goals and priorities. We can create a detailed bespoke plan addressing what's important to you. We can use things like cash flow analysis and forecasting and see where things drop in, and we can, you know, put in the future where you might come up with a big tax liability for IHT, and look at ways maybe in the lead up to those years that we can help extinguish or reduce that exposure. And here is how you can get in contact with us. And now we're going to move on to the question and answer session. Now, I have noted that we already have a couple, no, in fact 4 now, that have come up into the boxes. Now, some of these we might not be able to answer today, and some of these we might suggest that you get specific tax advice, but we'll go through some of these now. I'll read them out, so if anyone's thinking in terms of some of the same questions, at least you'll have a little think of the answer. So first question I've got here. We said that married couples and civil partners can pass their possessions and assets to each other in most cases. Could you please explain and expand further, i.e. does that mean that the IHT charge doesn't apply between married couples? So I think that's something that Kevin touched on, is yes, you can pass kind of both possessions and the allowances between married couples or civil partners. But I think it's very important that this is also outlined in a will, because in the UK, if a will isn't written with the individual's intentions outlined, it could actually fall into what's known as intestate, which means that it is actually kind of limited. It could be divided out, particularly if the individual that's passed away has maybe dependent or even non-dependent children as well. The court might decide to divide the estate up, not to the wishes of the individual. So don't assume that everything is going to go to your spouse. You should always make a will to understand, so everyone understands what your intentions are. So I hope that's answered that question.
Paul, do you want to pick up on the second one?
Go on. Yes, please, fire away. Yeah.
We have another question that was, if you gift an investment property to a family member for 7 years before you die, is capital gains payable on the transfer? The short answer is no, because you're gifting an asset and then living a further 7 years afterwards. So it falls outside your estate. The only thing you need to be aware of is that once you gift an asset to somebody else, you can't then no longer benefit from it. So if it's an investment property where rental income was being paid, you couldn't gift the property and carry on receiving the rental income. HMRC would then quite simply put that asset, the value of the property, back into your estate. So to answer your question, yes, after 7 years it falls outside your estate, but any rental income, if that was applicable, would have to be paid to the individual who you gifted the estate to. There's a couple of questions on the chat. I'll just run through if I may. There's a question: are there any differences for Australian farms? That's a very good question. You may be able to get some relief from an agricultural farm. However, it does fall into the commercial building or land and an asset which was carried on through a business. So it would fall into the taxable property. However, I will have to check if there's any relief that you get if it's an agricultural working farm, and I can certainly come back to you on that particular aspect. That's a very good question. Thank you. The question underneath was CGT comment. Mother passes away. The house is $2 million. Costs $1 million. I've been in the UK for 20 years. Are you saying the house would now be subject to CGT in Australia? The answer to that is yes. However, you do have the relief because it is classified as an Australian taxable property. You don't pay the CGT straight away, and if it was your mother's main residential property, you will have 2 years if you wanted to sell it without incurring a CGT liability. But after 2 years, you would do. Paul, do you want to pick up the next question on the Q&A chat?
Okay, so I've got a question. Oh, I've got a 3-part question here. What is the CGT rate for non-resident beneficiaries of an Australian estate? Some of this actually I might actually provide if you drop some notes into the inquiries. We can put some rates. We can put some rates down and have a and let you know, because there's differing rates. Gifting income, does income from shares and investments fall into this category? It's only income from earning that one gift outside of the IHT limits. So I think that was a point that you covered, Kevin, in one of your slides about gifts out of income. It's usually out of your regular income. So for some people, their income might be from dividends. Again, we would advise, or we would kind of take, we would advise you just to take tax advice as to what kind of your gifts out of income or gifts out of your regular income are. And the third question, at what age does deemed domicile rules apply for minors, i.e. does the clock start at birth or at age 18? Well, the point about domicile is, yeah, it's from birth. So it's very important, and in fact, it's not just from your, but it's from where you were born and where your father was born. So it can actually start from prior to when you were born, actually your domicile status. But depending on what you want to do, there are steps you can take to break your domicile status, and that might be beneficial for people certainly whose domicile is deemed to be in the UK and looking to move overseas. And there is also, from the Aussie point of view, you just want to make sure that your domicile doesn't necessarily move into being UK domiciled because of the IHT implications. So there might be other reasons outside of IHT where it might suit an individual to be domiciled in the UK, but by and large, because of the IHT purposes, for IHT purposes, most people would prefer to be domiciled outside of the UK if that is possible. I've got another quick question underneath to answer. Can you also do wills or refer to a solicitor who has knowledge of these matters? We would, in terms of actually drafting any documentation, which could be wills or kind of like the excluded property trust documentation, or any types of those legal documentations, we would generally recommend, and we can recommend, a solicitor that you would need, that you can use for the official documentation on this. There's a question I've got here. Superannuation is typically held in a trust. How is this treated for IHT in the UK for tax resident for tax for a resident and domiciled Australian based in the UK. So first of all, if you're a domiciled Australian, I think as we've touched on before, as long as you're domiciled Australian, any assets you've got outside of the UK, so that would include your Australian superannuation, would not fall into your state for IHT purposes. Once you become domiciled in the UK, again, these matters become a little bit more complicated, but generally speaking, an overseas pension is how it be deemed by the UK HMRC, or in this case, an Australian super, in most cases are deemed to be what's known as a qualifying non-UK pension scheme, or QNUPs is the acronym for that. And if a overseas pension scheme, such as Aussie Super, is deemed to be a QNUPs, that will fall outside the estate for UK IHT purposes, even if you become UK domiciled. So I hope that answers that question. As I said, any follow-up or any further questions or anything you might need elaborating on, you might not have time to cover in this presentation, but please mail the inquiries mailbox.
Thanks, Paul. There's a couple, just following on from your question that you answered earlier, Paul. Assets that are left to a spouse, would they still be subject to IHT over and above the threshold? No, they wouldn't. They would be for other family members, but there is an exemption between civil partners and spouses, whereby any value of the estate passed over to one another, there's no inheritance tax to pay. It's free of IHT. So hopefully that answers that question. We have a couple of questions on the chat. Is there any IHT planning that can be implemented if I have already passed the 16 years deemed domicile? Can you confirm that excluded property trust planning is no longer available? Yes, I can confirm that. If you have passed the 16 years and you're deemed domicile in the UK, then there are UK trusts that you can set up to mitigate inheritance tax. They're just regulated by HMRC, so it's purely UK trust that you can set up. More than happy to widen that conversation up to anyone's personal circumstances, and to have a look at what their objectives are, what their inheritance tax situation is, and certainly look at what trust could be available to you to mitigate any liability moving forward. There was a question on the Q&A. In UK DC pension pots are free of inheritance tax if you died before 75 years of old. Does the same apply to Aussie superannuation pots? Yes, it does. Under the dual tax treaty, if you're deemed domiciled here in the UK and unfortunately pass away before 75, any money in your Australian superannuation will be free of IHT.
Yeah,
in the UK.
That's right. That touches on the point that I might have said earlier, overlaps a little bit, I think, with the other questions in terms of Australian superannuation schemes are generally deemed to be what's known as a qualifying non-UK pension, and by their nature, they do fall outside of the UK for IHT purposes.
One question on the chat: how do I transfer Oz assets to the excluded property list while living in the UK? So if you had Australian assets and you thought the Australian property trust may well be of benefit to you, firstly, speak to us. We can give you some advice in respect of that. And then in conjunction with the solicitor, if we feel that advice is best and most suited to you, we would set that up for you in conjunction with a legal expert.
Just picked up on another question that's falling in the chat. Does money in the UK pension fund fall outside IHT? The short answer to that is yes, it does. So if you got money in UK pensions, it's free from IHT. Essentially, UK pensions are either written under trust or under contract. But the key thing is there, because the benefits from a UK pension are paid to beneficiaries at the trustees or the pension providers' discretion, then they do fall outside of UK inheritance tax. Any money that's got that an individual holds a UK pension. So the short answer to that is yes.
And we have a question. I'm going to pass that over to you, Paul, purely because it's a thread from a couple of previous questions, which I know you've answered previously. It's the last one on the Q&A regarding.
All right. So the question we've got here. So this is actually a really good question, and I wouldn't mind. Obviously, I'm quite happy to provide some information separately on considering this, because this would have actually been a whole section of slides on their own, actually. So is it true, if passing from a UK domicile to an Australian, either UK resident but non-dom or Australian resident, what are the tax? So yeah, it can actually be quite a complex area, so I wouldn't mind. I think it's Louise who's dropped that. I'm quite happy to answer that on kind of on a separate time. So by all means, please drop us an email, give us a call, and be quite happy to have a more kind of informed chat with regards to like moving assets between, or if you've got a couple with domiciled and non-domiciled, what the implications are of doing that, and the rules surrounding that. Okay, I think that is all the questions that we have today. I'm just having a look at our final box. Oh, just one question. This has been great. Oh, thank you. Can we receive a recording so we can listen again? I believe this is actually being recorded. So anyone who would like to see the recording and or need a copy of the slides, please just let us know. Okay. I think that's it for our questions. Bear with me. Just see if any last minute ones come up. Right. Okay. Yeah. As I say, we can provide our contact details as well. So if you want to contact us, I think we had inquiries at bdhSterling.com. My email address is pdavies@bdhsterling.com, and Kevin's is ktut@bdhsterling.com. So if you want to get in touch with us directly, in fact, our number you can probably see at the bottom here of the page. That's our UK number, and all our other contact details are here on this page as well. So for those that dialing in in the evening from Australia, that's our that's the kind of address and details of our local offices. Please feel free to get into contact, and either ourselves, bdhSterling, or maybe our sister on BDH Tax might be able to help you if it's more kind of in depth or complex tax queries. So more than happy to have at least an initial conversation with you. Okay, I think that's covered all the questions that's come in now. I hope that's been really useful. Any feedback, positive or negative, about the webinar would be appreciated as well. Apologies if we can't cover absolutely everything, and because some of the areas of tax, particularly like domicile, can be a bit of a grey area, that we can't be, we can't perhaps give some more definitive conclusions to some of the matters that come up, but we're more than happy to cover them with you separately. So thank you very much for joining today. So good evening for those joining us in the across in Australia, and good morning and enjoy the rest of the day for those that have been joining us here in the UK. Thank you very much.
Cheerio. Thank you.
Thank you.